Okay, ladies and gentlemen, here is some additional questions on question review on Chapter 11. This question asks for the margin for this investment opportunity. So take a minute and look over the question. I'll be back in 30 seconds. Okay, here we are back. You've looked at the question. The investment here is $800,000. The question is, what is the margin? So when you see a question like that, that means percentage margin, which is another way of saying operating profit over sales. Operating profit over sales. So the margin here would be, well, and they do it in a sort of a cagey kind of way. It's 50% of the contribution margin is 50% of 2.240 million. So half of that is 1.120 million. And then fixed expenses are 1,008 million. So we have 112,000 operating profit because it's contribution margin minus fixed costs equals an operating profit of 112,000. That amount divided by an investment of 800, that amount of profit over sales of $2.4 million, 2.240 million. This is sales. Equals, do that calculation and I'll be back. Pause the record. Okay, so this is a 5% margin, not 50%, 5%. And we got that by first calculating the operating profit, which is sales minus sales times the contribution margin of 50%. So that gives us contribution margin minus the fixed costs of 1,008, gives us operating profit of 112 over sales of 2.240 million, 5% margin. That's the answer to the question. Okay, take a look at it and we'll move on to the next. Okay, here's our next question, and the question here is turnover. Turnover. So we want you to pause the recorder for a minute, look at the question, and come back and we'll solve this one together. Okay, turnover is one of the two components of ROI. It's under the DuPont model. The DuPont model is ROI is equal to margin times turnover. And turnover is equivalent to sales over investment, or sales over assets. And it's a times measure. So take a minute. Here's my sales. Here is my assets. Do a quick computation of turnover, and I'll pause the recorder. I'll be back in a minute. Okay, you are back. So our calculation for turnover, sales over assets. Here's the calculation. Sales are given in the question 16.8. Assets are given in the question 7 million. So 16.8 over 7 is equal to a turnover of 2.4 times. So imagine turnover as being sort of how many times assets turn over end to end in sales. Another way of saying this would be for every dollar of assets, we will generate $2.4 in sales. So that's the answer to the question. Absorb that and let's move on. Okay, this question is based on ROI, return on investment. Take a minute, read this question, and I'll be back in a minute. Pause the recorder first, read it, understand what's given, and then I'll come back. Okay, let's break this one down. This company has a $1.4 million investment opportunity. So that looks like assets to me. So that's assets. And based on that opportunity, it earns a contribution margin of 40% of sales and fixed expenses. So this is a way we get to operating profit. Take a minute, multiply the sales times 40% to get the contribution margin minus the fixed expenses of 1,657,600, and then we'll get our operating profit. Pause the recorder, do that calculation. Okay, here's the result of that calculation. We took our sales times our contribution margin and got 1,792 contribution margin based on that first day. Get rid of this for a second here. And then continuing, we subtracted our fixed expenses from that to get our operating profit. So 134,400 is our operating profit. Our ROI is operating profit over operating assets. So that is equal to 134,400 divided by operating assets of 1,400. So pause the recorder. Okay, you've done the calculation. 134,400 divided by an investment of 1.4 million. 9.6 is our percentage. That happens to be our return on investment. So absorb that. Notice that you were required to calculate the operating profit first, and then you apply that to the basic fraction. This is not the DuPont formula, so operating profit over operating assets is your ROI. Okay, absorb that, and we're going to move on. Okay, this question is on margin. So what I'd like you to do here is pause the recorder for a second and take a look at the facts, and we'll come back. Okay, let's solve this one on margin. Question is, what is the margin? So the margin is operating profit divided by sales. That's the formula for margin. So this calculation is operating profit of 1.4 over sales of 14. So that looks, ladies and gentlemen, like a straight 10% margin. Very straightforward, nothing fancy going on there. Make sure you absorb that information and know how to do it for exam day. We'll move on. Okay, this question is asking us for last year's ROI. Very straightforward. So we see our average operating assets are 6 million. We see our operating income is, so this is assets. We see our operating income is 1,134, okay, operating profit divided by sales of, actually I don't even need margin for this, so let me time out here. I just need my operating income of 1,134 over my, it's operating profit over my assets of 6 million. Operating assets. So do that calculation, pause it, do that calculation. Okay, very straightforward here. For ROI, the formula is operating profit over operating assets. 1,134 is the profit. Operating assets 6 million. 19% is our ROI rate. Okay, that's about as straightforward as we can get, and that's a nice question, a good testable type question. So absorb that one for exam day, and let's move on. Okay, let's take a look at this question. The question is asking for residual income, or RI. So the formula for RI is equal to operating profit minus the capital charge. Capital charge. The capital charge is equal to the asset investment times the minimum That's not how you spell minimum. M-I-N-I-M-U-M, return. So that is the capital charge. So this is a dollar measure. So it's a dollar measure here. Read the question and come back to me in about a minute and we'll solve this one. You'll see how straightforward it is. Okay, after doing a little work on this, here's the relationship. We have operating profit of $143,700. That was given to us in the question. $143,700. We have the investment in operating assets of $970. We have a minimum return of 14%, which is given to us in the question. Look for these variables. By doing this multiplication, our capital charge is $135,800. That's the notional cost of what our opportunity cost of capital is. So if we subtract the capital charge from the operating profit, we get residual income, and that is equal to $7,900, ladies and gentlemen. So $7,900 residual income. That's how to do that. Very easy formula. It's a dollar measurement. So $7,900 is the residual income, and that's neither high, medium, or low. It depends on what the target is, but that's how you do that question. So absorb that information, please. Here's another residual income question in a slightly different format. Okay, you get more data here. What's the residual income from this year's investment opportunity when considered alone? Okay, so take a look at that in a little more detail and I'll come back to you in a minute. Pause the recorder and I'll come back. Okay, this is a little more unusual than it looks like. And residual income is equal to operating profit minus capital charge. We're just focusing on this one opportunity. So we first want to get the operating profit for this opportunity, and that's over here. A $459 contribution margin, a $306 fixed cost, which is a carryover, subtract that, and that leaves us $153 operating profit. So from that, we're going to take the 153, plug it into our residual income formula, which is operating profit minus capital charge. We get the $900,000 investment. So we put the investment of $900 and we get our minimum acceptable rate of return of 20%. So 20% of $900 is $180. So our operating profit minus $180 gives us a negative $27 residual income. And negative residual income is possible, nevertheless. So just absorb that one. That's a nice little calculation, very relevant and important to absorb that. Thank you. Okay, this last question is on the operational type measures, factory type measures. And here we are looking at a question that asks us for delivery cycle time. And this really, delivery cycle time means to the customer, So that includes the manufacturing cycle time plus the delivery cycle time. Okay, so you calculate this by looking at, and by the way, delivery cycle time is otherwise known as the wait time. Some terminology here. So this is definitely 28 here. We're talking about hours. So the manufacturing cycle time is the sum of all these items. Processing in the factory, inspection, move time, and queuing time. So all those combined give us 9.7 hours. So 9.7 hours plus the delivery cycle time, the manufacturing cycle time, delivery cycle time is equal to manufacturing cycle time plus the delivery time. So it's 28 plus 9.7. So the delivery cycle time is 37.7 hours. That's made up of a manufacturing cycle time,